Well, first of all, can I just say thanks for staying. The problem with the last lot was I thought it would just be me on my own, so I do appreciate you staying. In fact, I've got a lovely warm fuzzy feeling inside. And that doesn't happen very often at my age, I can assure you. So thank you very much. Now, who is this handsome fellow? I believe that my colleague Ian, who had the nasty technical thing to talk about, referred to Laurel and Hardy, and I often wonder who I would be. I've even got my waistcoat on. But instead of talking about the Blue Ridge Mountains of Virginia, I want to talk about the gold-filled mountains of Sierra Nevada. And what's the link between that and pensions? Well, I have to say you either need a very active imagination, or when I had my eureka moment and decided this was going to be the theme of my presentation, I find 3 or 4 pints had the necessarily effect. So follow my train of thought. But the idea, when the pension freedoms came in, the press really took to it, and they went on about this gold rush and people going in and stripping their pensions. And the bottom line is that as an industry, we didn't know what was going to happen. We did not have a clue how the great British public were going to react. The good news is we're 6 months into it. We're now seeing what's happened. And I just want to, in the first instance, is spend a bit of time just going what we've seen. Not only what the general industry's seen, but what James Hay has seen. And more important, probably the technical bit, is what have we learned? And when we're dealing with clients, what are the things that we should be discussing with them when they want to take money from their pensions? There's also something of greater concern, and that is what happens when the gold seam's worked out, is run out? What's happening next? Because there's a lot happening. And we know for a fact they're hoping to make an announcement in the autumn statement, and we're going to cover some of that as well, and what's happening and the reasons why. So, the 49ers v. the 55ers. Well, what I'm talking about, the 49ers, was the great Californian gold rush of 1849. Now, gold was discovered in the mountains. They tried to keep it quiet at Sutter Mills, but this man, Sam Brannan, he was the man who sort of let the cat out the bag, was the catalyst that started the gold rush, because he went parading down the streets of San Francisco with a vial of gold, saying this had been found in, I'd love to think he said, them dare mountains, but probably not. And what happened, the reaction after this, one of the biggest things in American history, was that the influx, San Francisco, where he told people about the gold find, 75% of the male population went off to look for gold. By 1849, the population of California had gone from 1,000 to 100,000. And people travelled from all over the world. They sold their property, they borrowed, all to come and look for gold. And the ironic thing is by 1850, all trace of surface gold was gone, and the only way you could get gold was by mining. And by 1852, it had peaked, and it started to go into a rapid decline. So the question was, Sam Brannan was the catalyst for the gold rush. Well, I say that Steve Webb was the catalyst when it came to pensions, because he was a man who stood up and said, if you want to go and buy yourself a Lamborghini with your pension monies, go and do it, and you can pick up from the state. Now, it was probably the wrong thing to say, because every newspaper you opened had a picture of a Lamborghini on it and all how easy it was, pictures of cash line machines and people accessing their monies. And I know from some of the earlier presentations, actually, it might not be as far off as we think that it is. But he was the man who started this. It's quite funny that he's gone from politics now to financial services. I'm not sure which rate's the worst, but anyway, there it goes. So we were expecting this gold rush. What actually happened? And the funny thing is no matter which figures you look at from whatever source, they're all different, but they do show the same trends. Even the financial FCS figures, which were released yesterday, they show the trends, but it's just their figures are lower than a lot of other sources. So what the Treasury said was that in the first 10 weeks, there had been 60,000 individuals taking £1 billion out of their pension fund. And this was their predicted tax take. And that's quite important, because there's no doubt that this is part of the Treasury's aim, is to get this deficit paid off. This is a good way to get lots of taxable income in as quickly as possible. The ABI, on the other hand, they estimated in a shorter period of time, it was 250,000 people had taken access to their pensions, and it was 1.8 billion. Just last week, they announced that actually for the first 3 months, it's 2.5 billion. So you can actually see it's starting to tail off a bit. And that's probably what we would have expected, because there was the build-up, people were all prepared to do the transfers, take the money out or whatever, but it's still a substantial amount of cash. Now, when you gave a breakdown as to what was happening within the industry, what they said was small funds, those less than 10,000, 50% of those who could take the money from their pension took it all out. It's quite a high figure. When it goes between 10 and 30,000, it goes down to 35%, between 30 and 50 to 12%. And then those who've got larger pension funds, say there's between 50 and 100, 2%. 100,000 plus, it was less than 1%. And that's quite interesting because, it's quite clear those with small pension pots, and they say the average pension pot fully encashed is £17,000. Well, as you know yourself, take your pension commencement lump sum, you're left with very little money to buy an annuity and a pittance of an income, so why not just spend it, do something with it? It makes a lot of sense, and I don't think anyone could argue with that. So what are the funds being used for? And again, if we went back to Rob's presentation, there's no great surprises there. 45% of the people who took money out were using it to repay debt. And I would actually think that's quite a wise thing to do if you're coming up to retirement and you're going to live off the state pension. 26% reinvested. We don't have a breakdown of what they mean by that, but they actually think a lot of it just went into bank accounts, which seems a bit strange. You've got this lovely low-taxed environment, and you're going to put it potentially into a taxed environment. And then, of course, there's a 29% that just went for lifestyle, the car, the holiday. And again, for a lot of people, it's probably a wise thing to do. So anyway, that's how they're spending it. Now, there were so many different figures going about, I thought I'll find out what James Hayes' experience is to date. And actually, I was really quite taken aback, because for funds less than 30,000, we had a 1.46% take-up, very, very low. And then it just gets lower and lower as we go higher up. And the interesting one is for those with funds in excess of $250,000, it actually rose slightly to 0.22%. Now, if you're anything like me and you're curious and think, in excess of £250,000, can we dig a bit deeper? Now, at James Hay, we do not ask people, what are you going to do with your pension monies once you get it? So we don't have that information on record. What we do know is what their occupations are or were. So where do we look? And the thing that struck me first of all was that the largest amount that was taken out in the one go was £1.7 million. To be precise, it was near a 1.75, but we couldn't get the 5 on the slide. So, substantial amount of money was taken out. Now here's the next bit. 75% of those who took money out were non-advised. And you're probably, it serves them right. But as you know, non-advised, and what we mean by that is that they carried out the instruction, they didn't do it through their advisor. So that's quite concerned. But then when we look at the occupations, well, it shouldn't hit us with any great surprise. Most of these people are professionals. You've got solicitors, actuaries. There's a fund manager down there. There is a chief executive officer. If Alistair had been in, I'd have seen if he'd been a bit flush with the cash recently, but I've heard that never happens. So it's quite interesting just to look at that. So that was our experience. What we have learnt is people are being very cautious, they're being very sensible. And that shouldn't come as any great surprise, because for anyone who's saved for retirement will obviously thought about the issues and the considerations and wants to retain that money and use it to its best advantage. And also if they've been advised about the tax advantages, they'll see there's a very good reason for keeping hold of it. So, we've got pension freedoms. What's the key to the door of pension freedoms? And it's the nominations. I have never seen anything in an industry where there have been so many different views of how nominations should be worded and what they should cover. And I actually call it a bit of a nomination nightmare. Now, first of all, congratulations to you all. The tax planning, fantastic. It doesn't form part of your estate. If you die before 75, it can pass on to your children, spouse, whoever, tax-free. They can then pass it on. If you die over 75, it's taxable, but still considerably less than inheritance tax. And you can control who benefits. You can skip a generation. They can access the money. The options are phenomenal. The question is, though, we've only got a simple little nomination form. And nomination forms are nothing new. So why all of a sudden people want to do these most perplexed things with them? You can understand the reasoning, but the problem is the legislation itself doesn't necessarily allow us to do all the things that people would like us to do. First of all, they don't want us to consider, they want us to actually do, which will have potential IHT issues if we were to do that, if it was deemed to be a binding nomination. So what we have seen is different providers taking different stances. Some firms are actively encouraging you, or maybe it's their business development managers who are actively telling you that you really should get as many nominees down as possible. And we now have what we call the 0% nominee. Now, we as a pension provider, if someone dies, one of the first things we will look at is the nomination. And if you're nominating people for 0%, then who makes that final decision? And what we are seeing is, I want the spouse down, a partner, ex-spouse, children from first marriage, children from second marriages, grandchildren, great-grandchildren. I was going to put a dog in that one, but he's not an individual. And they even have trusts. And the big question is, right, when the member dies, who decides what happens? Quite often we said their executors will decide. Who are their executors? Well, in most husband and wives, they're each, husband dies, wife is the executor. If they both die, it's the children. So this idea of multiple beneficiaries causes a great deal of confusion, and it is trouble brewing. And if you've advised your client to do it, then you're part of the problem. And if it all goes wrong, who they will come after. And that's the whole question is, yes, we like to make it flexible. Yes, we want to be as tax effective as possible, but we've got to do it in a way that will work and will achieve what the member wanted. So James Hayes' view is quite a dull one. First thing is, what is it actually the member wants? Now, you might want to do something, it's not tax effective or something, you can talk to him about it, but it's what does he want to happen? Keeping it simple. I have seen ones where they've got 40 nominees and they've given us 15 different scenarios of if this happens, I want this to happen. If this happens, I would like that to happen. And you're just and some of it you can't do because there's a dependent and they might be relying on us trying to nominate someone. And some of them actually, even though it says quite clearly this does not form part of my expression of wish, it actually does because they refer to it and they give you clear instructions on what they want to do. It could be disastrous. So you've got to try and discourage people from doing this. The key thing is that the nomination should be reviewed on a regular basis as and when the member's circumstances change or the beneficiaries or successors' position changes. So you do it at least once a year or if their circumstances change. And one of those big circumstances is when they suddenly hit 75 because if they die, the benefits are taxable, so they might want to skip a generation, something like that. So that's a key part of your review of your client, and it's more important now than ever. And we as an administrator, if it's a nice up-to-date one, and his circumstances have changed, but we know what his wishes are. Or even if you've got a record that you've spoken to them and they've confirmed they still want that nomination to be in place, it makes everybody's life a lot easier. Now, if other thing is, whoever you use, whichever provider, use their nomination form, because whoever's administering at the other end knows what their form looks like, knows that it fits in with the scheme rules, knows that it can achieve what it wants to achieve. And if there's something wrong in it, then they're more likely to notice if it's their own form. If the member drafts their own nomination, really discourage them not to do it unless they take full legal advice. And I can tell you we've seen a few corkers where people have given us not an expression of wish but a binding instruction. And we have to go back and subtly say, because I'm not authorised to give advice, have you considered the tax consequences? And is it going to achieve what you want it to achieve? So you've got to keep that very much in mind. The bypass trust. I love the bypass trust. It's kept me in a job for 17 years, so I was a bit concerned that with the change in legislation I'd have nothing to speak about, so I had to get it into the presentation. The nominations do not give you ultimate control. If you want to make sure that when you die, that it goes to your, let's say you're married for a second time, and then you want that money to go to your children, the only way you could guarantee that would happen is by using a bypass trust, not a nomination. Because even within your nomination, and you could still nominate your children, as soon as the dependent or whoever benefits from it is given that pension, it's their pension pot now. they can transfer it to another provider, they can take all the money out. They're in control. So if the person is concerned about control, then a bypass trust still fits in. Now, it's not as tax attractive, there's no inheritance tax benefit of having it, but when it's a question of control, it's very, very important. Now, one of the things we do know about is that from 2016, when you get hit with that horrible 45% charge for it going into the trust, it actually forms part of the tax pool. So when you pay that money out to the beneficiaries in the trust, they'll get a 45% tax credit with it, and then depending on their tax rate, they'll be able to reclaim the difference. So if they're a non-taxpayer, they can claim all the tax back. If they're a 20%, they'll get 25% back, and if they're a 40% taxpayer, they can have 5% of it back. You'll still take that big hit as it goes in, but you will actually manage to get the tax back at a later stage. And as I say, you're still putting the money into a highly taxed environment. Trusts are highly taxed, income tax, capital gains tax, and inheritance tax. But if control is the main concern of the member, then it is still the right decision. And you have to keep that in mind. And he might want to do it before he's 75 and then change his mind after 75 to do another option. So keep that very much in mind. And one of the things which I am no expert in at all is PAYE, but I do know the problems it can cause. And the bottom line is the PAYE system was never designed for ad hoc payments. It just can't handle it. It's good for nice, regular, steady payments, but as soon as you start playing around with them, it creates all sorts of quirks. And trying to rectify it usually takes a couple of years to sort itself out. Now, what that does mean is if you've got a client who takes out a large amount and that's the only source of income he's had, he'll end up being taxed a lot more heavily than he should be due. And that causes cash flow problems because we've seen people want to pay for their daughter's wedding or want to pay for a deposit for a property in Spain, and they fill out the forms, they've worked out how much they should get, and suddenly find out there's a shortfall. You've got to make sure that that doesn't happen, or you've got to manage the client's expectations that there may be a delay before he gets his full money. Now, James Hay would apply, if there was no P45 when they took the money out, we would apply an emergency tax code, which means they get 1/12 of the personal allowance, 1/12 of the basic rate, 1/12 of the 40% band, and then anything over that would be taxed at 45%. We don't know what other money he's spent or whether he's got income from other sources, but that's the basis we'll do the calculation. Now, real-time PAYE is supposed to resolve all these issues, because what it's supposed to do is your notice of coding can change very quickly, it goes straight on there, and it'll rectify the position, and by the end of the year it should have sorted itself out. But a story that I tell was, when the pension freedoms came out, I decided to up my pension contributions quite considerably. Phoned the revenue, 30-minute wait just to get through, but it's okay, I did it in the company time. I did multitask. I ate a packet of crisps at the same time. So, I had the conversation, 5 minutes, it's all done, Mr. MacGillivray, that's sing through, you'll see it in next month's pay rise. 3 months later, my pay slip, 3 months later, no set. Other half-hour call, same conversation, no, it's definitely, we'll sort it out, that should be it. And in an interim, they issued another notice of coding, and that's the one that they've gone by. So I'm about 6 months down the line, and I'm still not paying tax at the right rate. So, you know, it can be a bit messy. It will sort itself out, but don't assume that it will. The good thing is the revenue actually relaxed after some consultation. If someone has overpaid tax, there's a very quick process to get the money back. I don't want to bore you with all the new forms that comes with it. Yeah, you've got a P50, a P50Z, a P54, a P55Z. Don't know why, and they're all for different circumstances, but you can ask for the money back. And for a payroll scheme like James Hay, who's probably quite an advanced payroll, if there is an overpayment of tax and they're taking income the following month and everything else is going to cost, we can probably administer the refund. So you've actually got to check with the provider how good their PAYE system is. Some have very good systems, some have very poor systems. So again, there's a difference within the industry. The key thing here is we've got the client just say, you might not get all the money, you know, at the one time. Don't necessarily think, you know, worst case scenario, you get this, best case scenario, you'll get that. But just so they're not suddenly there losing their deposit for their dream home in Spain. So, and it's come pretty close to it. One of the things we have seen a great increase in is the insistent client. Have any of you had insistent clients? You know, they're in a defined benefit scheme, and suddenly they see the Holy Grail, cash, a bird in the hand, all that, the excitement of, yes, I can cash in my pension, how great it is. I actually heard there's a police officer who's done this. And you think of a police officer's pension, and you go, why in your right mind would you do it? Hyman Robertson have said, an actuarial firm, they've seen a 50% increase in the request for transfer values from DB schemes. And that goes throughout the actuarial industry. They're all saying it's about 45, 50% increase on requests for transfer values. So they estimate, Hyman Robertson's estimate that's 210,000 transfer quotes across the industry this year. Now, if you've got safeguarded benefits and they're greater than 30,000, you have to get advice. And that's the big thing. But the question is, when that client comes in and says to you, well, I come out of my defined benefit scheme, well, I'm into a defined contribution scheme, what do I do? How many of you are quite happy to advise on that? I come in off the street, big final salary pension. Yeah, exactly. Because you know yourself, there may be some reasons where it's a good idea and you can justify it, but more likely or not, all you can do is tell him the consequences of his actions and tell him that you cannot advise him to do it. And the decision that James Hay has taken as a company is that if they've not been advised to do the transfer, we will not take it. And we are not alone in that. I think the vast majority of pension providers have taken this stance because we know the money's going to come in, it's going to go straight out the door. 4 or 5 years later, we're going to get a complaint against us saying, my advisor said I shouldn't have done it, but you still took the transfer. You can't win. So the decision is we won't do it. There is one major problem come out of this, though, and it is not good news for the industry, and that is pension fraud is on the rise. Pension liberation, we've seen it in a massive scale, and it's getting even bigger. And I think one of the things we thought was that the pension freedoms might reduce that. It hasn't, it's rocketing. The City of London Police revealed that from April 2015, they had 1.4 million in losses caused by pension liberation. The following month, there was a 235% increase. And that's because all these people were lined up, they'd been texted, they'd been phoned, you know. And the thing is, there's an even new opportunity because previously, if you're in a defined benefit scheme, you know, you had to transfer and they would make all the arrangements. But for people who are in defined contribution schemes, you're entitled to free advice or free guidance. We're here to give it to you. And whilst you're at it, there's a great little investment, a bamboo plantation in some far-flung land, you know, and this is the returns which you're guaranteed to get. And if they're lucky, they might get some of their money back. More often than not, it's gone. And when they try and get in touch with these people, they no longer exist. You can't track them down. They are one step ahead, or probably 2 steps ahead of the regulators and the police. And they will tell you that themselves. It is amazing how well organised they are. It's a massive problem for the industry. So these are the things that we've learned and things I think you should be aware of. They're all, I'd say, reasonably small, but they're all very, very important. I think nominations probably is the key. But you know what? Pensions freedoms, great. Celebration, what a fantastic idea. Makes pensions look more attractive than ever. We have seen an uplift in people wanting to invest in pensions. It's all very positive. And the government now says, we're going to we're thinking about changing everything. You know. Now, what we're looking here is, first of all, the Office of Budget Responsibility, they do their fiscal sustainability report. They do it every year, and it's a 50-year projection of their income and expenditure. Now, they can't usually get their expenditure in a year right. How they can manage it for 50 years, we don't know. But it's a very important document to sort of refer to. And what they say is that the state pension under the triple lock is totally unsustainable. It cannot be sustained. They say that the estimated cost of the state pension will go from 5.1% of GDP in 2019-20 to 7.3% in 2064-65. And it's the same cost for healthcare and social care for the elderly. Social care for the elderly is going to go from 2% to 4%, which is a massive increase. So there's all this additional cost. So the current plan is, of course, is to make people work longer. They estimate that the state pension, when they originally said they were increasing the retirement age, they said it was going to be between 2044 and 2046. It's now estimated it will be in the mid-230s. Now, when you change the pension, they don't need to pass legislation now. They review it every 6 years. First review is due next year. They have to give you 10 years notice and 2 years to implement it. So they can actually bring that retirement age, increase it quite quickly if they want to do so. Now, as I say, they estimate by 2064 the state retirement age will be 75. There's something very significant about 2064. I'll be 100. Now, in my heart of hearts, I don't think I'll make it. I think lifestyle is going to be a cruel fate, but to be quite honest, having seen the figures, I actually think I'll be quite relieved. But what happens when you're 100? You get the telegram from the Queen. Well, you don't get that now. I think she posts it to it. But in 2064, will it be a text? Will it be an Instagram? Happy birthday, big boy, George, lol, happy face, wrinkly face. But I won't be around anyway, so I don't have to give it too much thought. But anyway, but what strikes me is my daughter will be 69. And she will still have quite a bit of time to work. And when you start to put it into that sort of perspective, then it becomes real. My mother, God bless her, 75, 76. Would you get in a car with her? Come on. Anyway, a couple of things about my mum. She has no perception of speed. She cannot look right because she's got a very stiff, sore neck. Physically, she can't do it. But she doesn't think that's a problem because she's got the assumption at the age of 76, you have right of way at every circumstance. So, you know, you've got to put these things realistically. But they've got this great thing about longevity. We're all going to live longer. We're all going to live longer. But I actually look how fit we're going to be during retirement. This is the most up-to-date information I could get from the Office of National Statistics. And it's bad news, girls. You're going to live longer than us, but you're going to be ill longer during that period. In fact, half your retirement, you're going to be disabled. Now, and the other thing is, as you think about disability, you think, but that'll be towards the end of my life. I'll have blown my pension, partied. But no, first of all, there's the hip replacement. Then there's the right hip replacement. And then the knees go. And somewhere in between that, a bit of bypass surgery. And these all will incapacitate you for quite some time. So we can't always assume it's towards the end of our life. But I was going through this with my wife. And I said, do you know that half your retirement you're going to be disabled and miserable? And I said, for the other half, you're just going to be miserable. Didn't go down well. No sense of humour. But this is the biggie. And Alistair spoke about this earlier, about the green paper. It's got the title, Strengthening the Incentive to Save, a Consultation on Pension Tax Relief. Sounds pretty not really that interesting, to be honest. But the aim, and you can't challenge the aims, to incentivise more people to take responsibility for their pensions, that the support from the government is simple and transparent. We're optimistic. Vital that the system is sustainable, and I think that's probably the main reason for the longer term. They do say they're approaching the consultation with an open mind. Now, as soon as the government says it's got an open mind, it really does concern me, because we've already had views that they've had working groups, Joe Public in, asking them questions, doing a lot of research. They've been through some of the pension providers to ask what the impact would be if they removed higher rate tax relief. So they obviously are formulating a plan. What is scary is they are actually hoping to announce the outcome of the consultation and what they're planning to do in the autumn statement, which is in November. So, you know, there is going to be big changes afoot. So what are the key drivers for this change? Longevity. We're all living longer. Demographics. A higher proportion of us are older and we're being supported by fewer younger people. All very serious problems. And it's not just within the UK, it's throughout all of Europe. But there's the biggie, 50 billion. And I love the way the revenue say, the Treasury say, 50 billion loss of income tax in national insurance. I thought you actually physically had to have it before you could lose it. But it's income that they think they might like to get their hands on. Now, I do accept the fact 2/3 of higher rate tax relief goes to higher and additional rate taxpayers. But here's something they don't tell you, is that 3 years ago, 1 in 10 people were higher rate taxpayers. For this year, it'll be 1 in 6. And that's because they're squeezing the marginal rate. But the other thing is, surely people who are higher rate taxpayers are the ones who've actually got the cash to save for retirement. They seem to think it's the complexity of the tax relief at source. Most people have got a rough idea how it works. It's not that complex. So, you know, we've got to think long and hard. And the other thing is they haven't given time for the reductions in the lifetime allowance to kick in, the reductions in the annual allowance, and as you're now all leading authorities on after this morning's session, tapered annual allowance. Yes, get their accountant to do it. So we haven't actually seen the full impact of those and if that changes. But the bottom line is someone leaves university, they've got a student loan, save for a deposit for a property, bring up a family. You know, you've got to have this surplus cash to pay for a pension. There's the big move from defined benefit to defined contribution. We've seen that mainly driven by the cost. But auto-enrolment, they reckon there'll be 8 to 9 million more saving for retirement come 2020. They're big numbers. And it's successful. So why suddenly do they want to change it? It really, really is a concern. And I love this from the Pension Policy Institute, but it's like any government body doesn't want to commit themselves to anything. According to them, you need to save it between 11 and 14% of your income to have a 75% chance of achieving their targeted income in retirement. There's a very simple reason. You want to say if you save 20%, you're guaranteed 100%, because we all know there's different factors. Investment return is one of them. So, you know, bottom line is we're not saving enough for retirement. One thing they do love is they love the way the financial services industry's gone, away from the sort of heavy charge with profit bonds and so on. They like the way the use of platforms and the way it's going. They say the whole way in which we sell and distribute savings products has changed, and they've got to adapt to that change. So what is the potential outcome? Well, what a lot of people would like to see is no change. It's a system we know that works. It fits in really quite nicely. And then we've got the move from EET to TEE. So you're going from an exempt, so you get your tax relief in the way in, it's in a low-taxed environment, and then it's taxed in the way out. So that's your normal pension. To a taxed exempt model, which is an ISA. So it's taxed income, it goes in, but when you retire, you'll be able to take the money out. So you've got to keep that very much in mind. It's going to be an ISA type thing, is one of the suggestions. Now, share this with me. A pension investment savings account. A pisser. I can just imagine the headlines. Watch your pension go down the drain. Yes, so you can tell our press officer's not here today. But it's true, you know. The other way they could enhance it, they might, for up to a certain limit, enhance it. Like, you know, for every £2 you put in, they put in a pound. A bit like the Help to Buy ISA, which comes out 1st of December. That could be the testing ground to see how popular and effective it is. But the chances are it's going to be a very, very low limit. The other thing, as we've seen in Australia, is make it compulsory. And the other point is, which seems to be gathering real momentum, is just to have a flat rate. And the popular rate seems to be 30%. But the problem is, that's okay for a defined contribution scheme. But what a defined benefit scheme? Because if I'm not getting full tax relief at my marginal rate and my employer is providing me a pension, what is the benefit of that pension? If I'm not getting 100% tax relief, I'll have to be taxable on it. If it's an unfunded scheme, someone's going to have to work out what the value of that benefit is. And as we all know, it'll be quite high and they'll be taxed on it. Now, I'm very aware of the time. So what's the outcome of all this? Well, those with bigger pension funds, we don't have to concern ourselves. They're being cautious. They're doing the right thing, as we expect. There will be the need advice to continue to grow, but there's big changes afoot, and we'll have to see how that impacts. But we'll still maybe running with 2 different types of pension scheme. So still advice on the existing schemes that we have at the moment. We have to learn from our experiences, and when you're dealing with clients, it's important, things like how the PAYE system works when they're taking money out. The future of platforms does look rosy, because whatever decision they come to, platforms will be able to deliver it. Bypass trusts, there's still a place for them, not for tax planning, but for control of capital. And you have to be aware of the major changes ahead. And if that's depressed you, I'd like to finish in a high. And that is, you should be encouraging your clients now to max out under the rules that we have and use up their car, you know, try and max out as much as possible, because we don't know how long we're going to have this. So I hope you found that of some benefit. Thank you very much for your time.